All right, well, just want to welcome everyone and thank you for taking time out of your day to attend another one of our wealth building webinars. Today, we're going to be focusing in on income stocks and retirement planning. So I'm very excited to be joined by the two Johns, John Buckingham, which most of you know, and then John Roessler, one of our senior financial planners from our Kovitz Chicago office. And so how this is going to work today, first I'm going to hand it over to John Buckingham, and he's going to spend 15 to 20 minutes talking about income stocks. And as you can see, his title page, In Dividends We Trust. Then we'll transition over and I'll be doing a Q&A with John Roessler on some very general questions around financial planning. And then with the time we have left after both of those things are complete, we'll do a Q&A. So if you look at the bottom of your Zoom screen, you'll see a little Q&A that you can press on and you can type in any questions you have, whether they be for John Buckingham around income stocks or the markets, or they can be around financial planning for John Roessler, and we'll then address the questions that we get. If we don't get to all of them, we'll either respond to you specifically if it's more of a specific question, or if it's more of a general question, we'll blast that out to everybody that was in attendance or put it on our blog on the Prudent Speculator website. And so with that, I am excited to welcome John Buckingham, the editor of the Prudent Speculator newsletter and also a senior portfolio manager here at Kovitz. As many of you know, John has been doing this for more than 37 years, and I've had the honor to work alongside him for the last 17 years. And so, John, with that, I'm going to hand it over to you to discuss income stocks.
Great. Thank you, Jason. And again, I appreciate everybody coming out today and taking part in our webinar. The last one we did was talking about our outlook for 2024. We, of course, are consistent in our approach in that we firmly believe that buying and patiently harvesting broadly diversified portfolios of undervalued stocks, generally of dividend payers, to be held for their long-term appreciation potential, is the way to go. I probably said that line 1.2 million times, it seems, in my 37 years here. I have been an Al Frank disciple since 1987 when I came on board as a senior in college. And I'm very fortunate that my avocation is my occupation. I always put this slide up on the screen just to show that I'm losing my hair. But no, it's that we've said the same thing, whether the Dow is at 7,500 or the Dow is at 18,000 or the Dow is at 38 or 39,000. And we'll be saying the same thing when the Dow is at 100,000 down the road. So the message is very simple. And of course, the thing that we always like to focus on are the facts. Market history is a guide. It's not the gospel. Just because things have happened that way in the past doesn't mean they're going to reoccur. But over time, equities have proven very rewarding. And it's not without plenty of ups and downs along the way. You can see that declining markets of 5% or more happen 3 times a year. Right now we're pretty much at an all-time high on the major market averages. So for most people, they're not necessarily thinking that there is downside action in stocks. But of course, 2022 was an awful year, and we've had many poor years throughout our history. But over time, the odds favor those who stick with stocks through thick and thin. And you can see on the chart on the right there that dividend-paying stocks have outperformed non-dividend paying stocks. And of course, value stocks have outperformed growth stocks. So it's shouldn't be any surprise as to why we like to invest in dividend-paying value stocks. And if you look at periods of time going back 20, 30, 40, 50 years, or all the way back to the 1920s, you will see that an equal weighted portfolio of value stocks has outperformed growth. And the same thing for dividend paying stocks, even though the last several years, of course, have been a different story with growth outperforming value. So the odds, again, I think favor our style of investing, again, for those who have a long-term time horizon. And one of the challenges we face these days is that we are constantly bombarded by tales of riches that can be had in instruments that there's always greener grass, I guess, is the point I'm trying to make, that value stocks have done just fine over the last, 5-10 years. But yes, there are other investments that have had higher returns over that time span. But we're focused on being able to sleep at night, being able to invest in businesses. And I like the Ben Graham quote, the true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operation results of his companies. So it's very important to keep in mind that stock prices will go up and down, and you're going to get a significant portion of your total return from capital appreciation, but you're also going to get it from dividends and the reinvestment of dividends. And one example that I'd like to use is of IBM. And for those who have subscribed for a number of years, they know that we've long owned IBM and have long recommended it. And frankly, we've heard from many subscribers and even clients as to why the heck do you want to continue to hold this stock? Because in their mind, it hasn't done much. And the thinking is, well, you bought it at, maybe a little under 100 and, it's now, well, it's a little higher than this chart shows, but the price appreciation hasn't been all that grand over the, 17 years or so that we've held the stock. But the important thing to think about is the total return, because IBM has thrown off substantial dividends, and those dividends can, of course, be reinvested in IBM or other stocks. So believe it or not, IBM has actually been a better performer since our original recommendation in 2006 than our benchmark index, which is the Russell 3000 Value Index. So the next time somebody says, well, that stock hasn't gone anywhere, you want to make sure that you're considering how it's performed on a total return basis. So what the dividends you've received and how those have compounded over time as you reinvest the dividends. And there's, that was an example of an individual stock. I also think it's important to understand from a market perspective, because we've often heard those who are pessimistic about stocks talk about how, boy, if you have a big decline, it could take forever just to get even. And often they'll point back to the Depression. 1929, we had the stock market crash, and it took 25 years to get for the Dow Jones Industrial Average to get back to the level it was at in 1928. So if you look at the chart, it went from 300 on the Dow in 1928 to 280 in 1953. So that massive amount of time, a quarter century, the stock market, quote unquote, went nowhere if all you did was look at the Dow Jones Industrial Average. But if you actually look at what the individual stocks did and then the dividends you received on them and the dividends potentially reinvested, you will see that value stocks over that time span averaged an 8.3% return. That's not total, that's per year, 8.3% per year. Dividend payers were 6% per year. So during a period of 25 years where many people think that somehow stocks went nowhere, the effect of dividends and their reinvestment gave you a solid return. I'm not suggesting 6% is a great return on dividend payers, but it certainly is a different story than somebody telling you that you made no money for 25 years. So it's, again, very important to think about dividends. Dividends are tangible. John Rockefeller said, do you know the only thing that gives me pleasure? It's to see my dividends coming in. Well, that's a sad state of affairs for Mr. Rockefeller if that's all that gave him pleasure. But there is something tangible about having an income stream coming to you, that the investment you're making is producing some income for you. And then, of course, you don't have to reinvest in that same company. You can invest in other stocks, as we do. Or for many investors, they actually need that income, to pay the bills and to live on. So the nice thing about dividends is that they are not set it and forget it, so to speak. Dividends rise over time, at least they have historically. There's no guarantees. There's never any guarantee, right? But dividends have historically risen over time. And for those who follow our newsletter, the model portfolio is TPS portfolio. Money's actually been taken out of that portfolio. Remember, Al Frank passed away in 2002, but it's still his heirs portfolio, and they take the income from it. But the amount of dividends have more than doubled in the last 10 years in terms of what the portfolio has generated on income. And historically, again, dividends have risen over time. So you have to keep that in mind as well, that just because a stock might be yielding 3% today doesn't mean that it's going to be yielding 3% forever, especially when you think about your cost basis. And dividends can rise and have risen over time because the economy has grown. Companies have become more valuable. They've made more money. And part of the reason for making more money is that the economy grows. And the economy generally grows substantially over time. The chart I have up on the screen, though, is talking about Apple. And when I mention this concept that dividends will increase over time, most people today don't think of Apple as an income investment. But believe it or not, back in 2013, Apple had a dividend yield of 2.8%. Believe it or not, 2.8% for Apple in 2013. At that time, they decided to do a debt offering, and they issued debt at a yield of 2.4%. So this was financial alchemy. Apple essentially took money from the debt holders, and what did they do with those proceeds that they raised? They bought back stock, so retired stock that was costing them 2.8% in yield by paying 2.4%. So that's why I say it was alchemy. So again, ingenious by Apple to do that. And that debt offering was oversubscribed. Everybody wanted to invest in a super safe company like Apple on the debt side. Well, the interesting thing was that Apple has raised its dividend and raised it consistently over those 10 years. So that initial 2.8% yield, had you bought Apple in 2013, and just thinking about the income, you would have then had a 6.2% yield on that original investment because of all of the dividend increases. Apple doubled its dividend. Now, if you were a bondholder, you got your 2.4% coupon, and you got that for 10 years. It didn't go up, it didn't go down, but you got it. And so you invested your $100 in Apple, and it was worth essentially $100 10 years later on the bond side. Now, obviously, on the equity side, the return was a little bit better, going from split adjusted something under $20 to, at the end of that period in 2023, $167. So you got capital appreciation. But the point of this is to show you that not only did you get the capital appreciation, you got the dividend and a much better yield by investing in an equity than you would have been investing in the bond. Now, obviously, stocks are volatile and stocks are riskier, and bonds have a place in most allocations for investors. But again, an example of why I think dividends are sometimes misunderstood. We don't talk about them a lot in terms of market averages. If you're watching CNBC, nobody says, well, the total return for the S&P today was X or Y. It's always about only the change in price and not about the total return. And I mentioned that GDP has grown over time, and that's a big major reason that stocks can pay higher dividends, and they can pay higher dividends because earnings have increased over time. So earnings will rise as the economy grows, and that will, in all likelihood, depending on how well you select your stocks, will allow the dividends to actually be higher over time. And again, that's been our experience on average. It's not that every company is going to be able to raise its dividend, but the overall portfolio is what's important. And that's what I showed you with TPS portfolio earlier. So one of the problems, of course, for investors is that there are great rewards out there from the stock market, but they have a very tough time ignoring all of the noise, and they end up on an emotional roller coaster. So I like to say, if you don't change direction, you may end up where you are heading. And that's what we think is super important. And part of this presentation, including the financial planning, is to get folks on a path to achieving their long-term investment objectives so that they don't worry about the short-term fluctuations, and they stay the course through thick and thin because they set up the plan correctly in the first place. But when you think about risk, most people, of course, think about volatility. And stocks tend to be volatile assets. They go up and down in price. One of the things that is fascinating about dividends is that they have been a risk dampener, not a risk eliminator, of course, but they have dampened the overall volatility of stocks. So most investors are seeking the holy grail, which is higher returns with lower risk. Well, this slide that's on your screen now shows you that dividend payers have had a lower standard deviation or lower volatility over time, and they've had higher returns over time. So that is sort of the holy grail. Now, the fact that dividends have done well is terrific, but you have to stick with those stocks through thick and thin. So we like to show, again, lots of data for those who subscribe to our newsletter. We put out a ton of information to hopefully allow you to sleep better at night and to stick with the program when stocks aren't always going up. But one of the things that I think is fascinating is that if many investors view the stock market as a casino. Somehow they think it's out to get them. Somehow they think the odds are stacked against them. Well, that's not the case. The odds are actually stacked in your favor. So if you hold dividend paying stocks for 1 year, or for 1 month, I should say, you have a 60% chance of making money and making more money than you would by investing in, this case, the Treasury, 10-year Treasury yield. So you would make on a better yield than the 4.28% annualized return 60% of the time. So you're better off in stocks than you are in quote unquote risk-free assets 60% of the time in dividend paying stocks if you hold for 1 month. But if you take that out to 1 year, you're better off 69% of the time. And you go out to 5 years, it's 82% of the time. And you get all the way out to 20 years, it's 98.6% of the time. So for those who have a long-term time horizon, equities are certainly very appealing and should be very appealing. And again, if you're thinking about, but I don't want as wild a ride as some others may be having in terms of investing in stocks that may not pay dividends or may be part of some, whatever the excitement of the day is, whether it's cryptocurrency, cannabis, meme, you name it. There's always something that excites investors. But for us, we'd rather be the tortoise and the hare and grow wealthy slowly and let our dividends accrue over time. So the moral of the story is the secret to making money in stocks is not to get scared out of them. And we hope and think that the tools we provide each week in our market commentaries and in our newsletter will help investors ride through all of the ups and downs. Because, again, history doesn't repeat, but it does rhyme, is what Mark Twain said. And so we think there's plenty to be gained by looking at what has happened, previous times, that whatever event might be concerning, today, it's happened before, whether it's Fed raising interest rates, Fed lowering interest rates, whether it's inflation rising, inflation falling. We crunch all the numbers and present all that in our commentaries. So that's the important part of what we do, is trying to, again, invest the way we think folks should be looking at the stock market. It's not about it being a casino. It shouldn't be exciting. It should be watching grass grow, is how we like to think. And so the whole point of the first part of this presentation is, again, to try to illustrate why we invest the way we invest, because that's far more important than the actual stock picks, which are about to come up. So I always give that caveat that, it's the strategy, the philosophy is far more important, and the broad diversification. Our winners have won more than our losers have lost. And, Apple's obviously been a home run for us over the years. But if we went back and were honest, when we first bought Apple back in, say, the year 2000, it might have been stock number 78 on our list of favorites at the time. And it just so happened that it became, our biggest winner ever. We bought it for the right reasons, but we also bought other stocks at that time as well. And, some of those did not, of course, do as well as as Apple did. So without further ado, we'll move on to the income stocks, because I know folks like stock picks. And one of the quotations we also like is from Warren Buffett. Whether we're talking about socks or stocks, we like to buy quality merchandise when it is marked down. So when I'm always asked for stock picks, I try to give things that haven't had their day in the sun. Maybe it doesn't make us look as talented or as good a stock picker as if we said, hey, today you should buy Apple, or you should buy Meta, or you should buy some of our other stocks that have done really well. I'd rather offer things that haven't had their day in the sun. We're like the farmer. We plant our seeds, in the spring, and then we harvest in the fall. But this is time for planting, because many stocks have not participated in the big rally that we've seen over the last, say 5 quarters. So the first name on the list is a stock that has struggled. It's Whirlpool. It's the big appliance maker, and it's a company we've owned for quite some time, and we're getting a 6% yield today. And we think that yield and the dividend is well covered by the profits of the company. So yes, it hasn't been growing in terms of the bottom line the last couple of years, and that's okay. Again, we'd like them to, of course, see that bottom line start to grow again, but the price we're paying for the stock is very inexpensive at 9 times earnings, and we do think there is growth potential to come down the road. So Whirlpool would be one of the many stocks we own, but one of the 7 we chose for this presentation. And again, we're emphasizing yield and valuation is what the point of this exercise is today. So we've also seen regional bank stocks have been hit hard, especially since March of last year, when we had the mini regional bank crisis with Silicon Valley, Signature Bank, First Republic, all going bust. So the babies were thrown out with the bathwater, in our opinion. PNC Financial, we think, is a higher quality regional bank. Dividend yield is over 4. And we've seen them navigate through tough times before in the banking space and come out with flying colors on the other side. So for those who like to go into areas of the market that maybe have not performed as well, I like the idea of sticking with a higher quality name, especially when you're an income oriented investor. So energy stocks are also an area where the prices of the stocks have not appreciated much. They've still managed to crank out substantial dividends. We just recently recommended Devon Energy, adding additional oil and gas exposure to our portfolios. One of the things we like about Devon is that they are a very low-cost producer. Under $40 a barrel of West Texas Intermediate crude is their break-even cost. And they're very shareholder-friendly. In terms of rewarding shareholders with special dividends. They have a fixed program, and then they'll do a variable depending on profits. And so the yield today is roughly 7%. And so we certainly like oil and gas producing companies. Yes, the world is gravitating toward electric vehicles and alternative energy, but that's going to be measured in decades in terms of the adoption. And we're still going to have substantial need for fossil fuels for the foreseeable future. And frankly, there hasn't been as much investment in fossil fuels as probably there should have been to meet the demand that we will still see over the next couple of decades, in our opinion. Healthcare stocks have also been an area that have lagged because, of course, we've been in a tech-focused market environment. And CVS, which is, of course, they own the pharmacies. They own a pharmacy benefit manager company called Caremark. And they also own Aetna, which is a health maintenance or HMO entity. And so all of those are under one roof. We think that there's plenty of synergies there from those businesses. And we still think earnings are likely to grow nicely, but yet the stock is trading at a very inexpensive multiple and gives us a 3.4% yield. With CVS, we're thinking there might be more capital appreciation than income return over time, but there's nothing wrong with a very generous dividend along the way. We also see opportunities across the pond, overseas. Foreign markets have lagged behind US markets in terms of return for a number of years. So DHL, which is Deutsche Post, of course, most of us know what DHL is if we've shipped packages, especially if we sent anything overseas. But again, another inexpensively priced stock that we think Europe is poised to eventually come out of their economic malaise. And the time to plant those seeds, of course, is before the sun comes out. And we do think that DHL is a name that investors should be taking a look at. I mentioned tech earlier. Obviously, we've done very well with many tech names. Cisco Systems is a name that has not participated as much in the rally as many of the quote-unquote AI stocks have. And even though Cisco is a longer-term AI play and has a multiple in the 13 range from a PE standpoint, which is extraordinarily low relative to where most tech companies trade, and we get a big dividend yield for a tech company of over 3%. So we think Cisco's a name that investors should be focusing on, especially those who have been taking money off the table in some of the high-flying tech names, as we have. We've been taking profits out of some of our tech names, especially as they've just rocketed higher, riding the coattails of NVIDIA. And finally, a name that is a little more expensive on a PE basis, but is a very high quality company, Air Products, which is an industrial gas company. Stock got whacked here a few weeks back, and it's a name that we think should be in most portfolios. Today, the PE is below 20. Usually it trades above 20, and you get a dividend yield of over 3%. So again, these are 7 names. We do have many recommendations, as those in the newsletter know. I have to show you this from a compliance perspective so that I didn't cherry pick those 7 stocks. Personally, I'd like to own all stocks that you see on the screen. But for this presentation, we only did 7. And I need to show you our compliance as well, so you can read through all those notes. Basically, past performance is no guarantee of future performance. But again, I think that history is very valuable, no pun intended, in helping you stay on track to achieve your long-term investment objectives. And so furthering that discussion, I'm going to turn it back to Jason and John to talk more about how we think Kovitz might be able to help you in reaching those goals. And even if you're doing it on your own, there are many things that we think you should think about as you focus on your overall asset allocation and long-term investment plan. Thank you.
Thank you, Mr. Buckingham. Just want to remind people down below at the bottom of your Zoom screen, there is a Q&A button, and you can click on that and enter any questions that you might have for John Buckingham, or as we move through this Q&A with John Roessler, if you have any questions that come up, you can enter those there for him also. And then if we have any time, because we want to stay to the hour, if we have any time, we'll visit some of those questions that we're receiving. And if we don't get to them, again, we will either address you individually or we'll put them on our blog to share them with everyone. So just versus focusing on stocks as we often do in the Prudent Speculator, we wanted to add a little flair and spice to this webinar and invite our teammate John Roessler from our Chicago office. We're very excited to have John with us, and we're very blessed to be able to utilize his experience and his expertise in the financial planning space. John Roessler has been doing financial planning for more than a quarter century. John is both a certified financial planner and a certified public accountant. So we think that makes it unique. Many of our direct private clients, private wealth clients that John and I have just are able to serve on a daily basis, they have gone through these planning exercises, and they've gotten to experience what John Roessler brings to the table and helping them chart a path forward. And so with that, John, just want to welcome you to the webinar.
Yeah, delighted to be here. Thanks, Jason.
Awesome. And so what we're going to do, so we've just come up with some general questions through what we've heard from clients in the past or prospective clients, and just reading through all of the things that we read through. And we wanted to just pick John's brain on a few different areas. And so, John, I'm going to start out with this question for you. In your experience and what you encounter, what are the three to five biggest planning mistakes or money mistakes that people make?
Well, for those who don't have unlimited resources, of course, spending too much and not saving enough or retiring early are the big mistakes. But for people who are the number one biggest mistake, and it's probably going to sound like I'm boasting, but I think not working with an advisor is the biggest mistake, because personal finance is an emotional business, and when people may let their emotions guide them in making really important decisions, mistakes are made. And so An advisor is going to have a steady hand and help you through when the going gets tough. And hopefully your advisor is competent and available to be sort of the quarterback of your financial life. The other thing I think is not establishing an asset allocation. Often enough clients come to us and they don't have really an asset allocation strategy. They have a collection of stuff and there's no real plan. And these same people would not necessarily, if they were going to build a house, they wouldn't not go to an architect and have blueprints drawn up. So an asset allocation strategy is what determines your returns. It's the key to buying low and selling high if you're rebalancing your portfolio back to your allocation targets. So I think those are the biggest mistakes.
All right, thank you, John. Next question that we've heard a bunch of times as people are approaching retirement. What are things that people that are approaching retirement should be considering when they're thinking about their financial plan?
Yeah, sure. Getting back to the asset allocation, your asset allocation should be relatively static. You don't want to change your asset allocation when the stock market is down 20%, for instance. But mostly allocation should be a function of your time horizon and tolerance for volatility in the portfolio. But when you get to retirement and you're no longer drawing a paycheck, it may feel as though the bottom is dropping out from under you, and so it's a good time to kind of take stock and see whether maybe reducing equity exposure is right. Obviously the worst thing that can happen is for you to have lots of stocks in your portfolio, and upon retirement the stock market goes down and you become anxious and you sell everything. So that's what you want. That's why it's so important to revisit the asset allocation. And you think about it, and I think we're gonna talk about sustainable portfolio withdrawal rates. If one way to look at it is if you figure 4% is the sustainable portfolio withdrawal rate, and that's open to debate, but and you're thinking about how many years of non-volatile assets you want to have stashed away to like help you sleep at night, that's something you might want to consider at that time. The other thing that I would recommend is getting with your advisor and reviewing your plan to make sure that you're on track for a successful retirement. As we like to say, you will retire once in your life, but we do it routinely with all our clients. And I think that the thing that our planning does that's most valuable, because we don't have a crystal ball, we're just giving you information with which to make these decisions. But it gives clients peace of mind and really gives them confidence to go forward in retirement and enjoy it. So those are the two biggest things I would recommend as somebody is kind of rounding third and heading for home, so to speak.
Thank you, John. Well, then if we're talking about the rounding third and heading to home, when we consider people that are just first into retirement, I know you and I have worked with some of our clients and we talk that are heading into retirement. We talk to them about, after the first year or two, revisiting the plan because of certain things that happen at times when you first enter retirement to kind of when things settle out. So in your over a quarter century of experience, what's the biggest issue you see that people aren't prepared for with their plan when they when they're in retirement?
Believe it or not, and because we work with mostly affluent people, but the thing that gets people most at retirement is becoming accustomed to being dependent on their portfolio instead of drawing a paycheck. And that has the effect of constraining people's spending. And so again, from our perspective, revisiting the plan, getting that surety that everything is on track can provide you just invaluable peace of mind. but yeah, I think one other way that some people studies have shown that some guaranteed income like an annuity can help people overcome that unwillingness to dip into the portfolio. So.
Right. Well, earlier you kind of mentioned the withdrawal rate debate. And so there's been a lot of recent press over the last few years. And I know we've gotten the questions individually, but I guess at the end of the day, is the 4% withdrawal rate rule still the golden rule when it comes to retirement?
Yeah, I don't know about golden rule. First of all, the 4% rule is something that Bill Bengen did research and discovered that for a couple who has a 50% stock, 50% bond portfolio, their sustainable portfolio withdrawal rate over any 30-year period is 4%. And so that sort of became the guide by which advisors counsel their clients about how much they could withdraw from their portfolio. But, you know, when you think about it, the 4% was based on if you happen to retire at precisely the very worst moment possible and experience, you know, the worst markets. So it really depends on when you retire, and you don't know that when you retire what the market's going to do. And so I don't think anybody, you know, wakes up on January 1st and says, okay, we got $1 million in our portfolio and we're going to take 4%. That means $40,000 this year. You know, you have to live your life, and sometimes that's going to mean taking 6, 7, 8% out of your portfolio. But there's certain ways you want to have a dynamic sort of withdrawal rule. That is, when the market is doing well, then perhaps those are the times when you can exceed the 4%. And when the market is doing poorly, and again, I think that people who are in retirement, dependent on their portfolio, and they see their balances dwindling, they are naturally constrained anyway. And so ultimately, the 4% rule is really a great and helpful guideline for kind of gauging where you are relative to the universally sustainable portfolio withdrawal rate. And you know, some years you're going to want, particularly just after retirement, you know, you've got probably a bucket list. You want to do some traveling, whatever. And so you may decide, even though 4% is the universally sustainable portfolio withdrawal rate, there's some things that I want to do. And I acknowledge that if I withdraw more than 4%, you know, in the first few years of retirement, there's going to be less down the road, and I'm willing to accept that and adjust accordingly. So those are all things to consider when thinking about the 4% rule. When I look at planning for clients, that's the first thing I think about is how much are they taking out of their portfolio on an annual basis in terms of percent. So it's very important.
Thank you, John. Well, considering that then, so what are a few ideas or a few ways that a person can enhance their withdrawal rate if they are overall flexible about spending?
Well, again, you know, when the portfolio is doing poorly, you want to dial back. You maybe don't want to take the extra vacation that year, or you could postpone buying the new automobile, for instance. I think there's other ways that, in terms of managing your portfolio, rebalancing regularly, you know, for some people, 50% stocks and 50% bonds may be too conservative, and stocks over long periods of time are going to give you greater returns, but you have to deal with the additional volatility, and that makes you vulnerable to what's called sequencing risk. And that's the risk that immediate returns are going to be poor, and in the meantime you're taking money out of your portfolio, and you permanently lose money as a result, thus hindering the likelihood that you're going to achieve your goals. Those are all considerations. So.
All right. Yep. So again, diversification and allocation disciplines are very important. One of the things when we were communicating before, you brought up that there were studies that showed spending reduces as we get older. Could you just touch on that a little bit?
Sure.
And obviously that would be a positive impact to the overall plan.
Yeah, there's a thing called the smile curve, which describes typical spending for retirees. And basically it starts, usually spending decreases by the time one retires compared to one's working years. And so it decreases immediately upon retirement and continues to slow down. And then when healthcare costs or long-term care costs start to ratchet up, the spending creeps back up, and that's what the smile curve is. But generally speaking, yeah, the spending reduces upon somebody's retirement.
All right. Thank you. So now we've kind of talked about mistakes and ways to do things, but let's talk about some opportunities. So in your planning career and all that you've done and accomplished in this space, thinking current, what are 3 or 4 or 5 opportunities that you think people could or should be taking advantage of?
Well, there's people may be aware that the Secure Act 2 introduced a provision that allows for people to convert 529 assets, that's the qualified educational accounts, into Roths. So the deal is your child beneficiary will have the ability to convert. It's subject to limitations like the annual contribution limits, and it's a lifetime limit of $35,000. But for the first time, this provision will allow people to kind of, I think it'll encourage people to contribute more to 529s, because one of the big hangups in getting people to contribute is because they say, well, what happens if my child doesn't go to college or gets a scholarship or doesn't use it all? There's a reluctance to contribute it. And I'm a huge advocate for 529 accounts. I don't think there's any, that's the best way to fund someone's college. But also, I mean, there's no better gift than giving education to somebody. So I think that's going to be a big thing, and people are going to get excited about. One thing to keep in mind is the account has to have been open for 15 years. It's not clear yet. Congress has to issue some regulations, but it's not clear whether, if you change a beneficiary, which you can do with a 529 account, let's say from your child to you, whether that starts the 15-year clock again, remains to be seen. But either way, it's a great deal, and I think people should take advantage of that for people whose children are done with college. The other thing that I think that people should consider, and it's been around a while, so people are probably aware of it, but backdoor Roth contributions. In order to make a Roth contribution outside one's 401k, it's subject to adjusted gross income limitations, and if you exceed those limitations, you're not able to make a Roth contribution. However, if you make a non-deductible IRA contribution and you don't have any, it's a new IRA account, you don't have any other IRA assets, you can make the contribution to the IRA and turn around the next day and convert it into Roth without any cost, because everything that's converting into Roth is all basis, and so it's a tax-free transaction, and it's a way for people who otherwise wouldn't be able to make Roth contributions to do that, and that's a really valuable thing. The other thing is Roth conversions. We get a lot of questions about Roth conversions. They're not for everybody. In fact, I think there's probably a lot of water cooler talk about Roth conversions, but the goal is to convert the assets at a rate that is lower or equal to the rate that you would otherwise eventually take distributions at. That would include your heirs. So the challenge is finding when you can do that. And it's a particularly germane strategy for people who just retired, because they're not drawing a paycheck, they're not subject to required minimum distributions, and so if they're living on after-tax dollars and basically in a capital gains marginal income tax rate, you've got some room to maneuver and include some Roth conversion in your income. And the goal is not, to someday have no income taxes. The goal is to have the lowest average marginal income tax rate over your lifetime, and that's a really great time to do it, like I said. So.
Awesome. Thank you, John. You went right back into those Roth conversions, because that was going to be my question, because we've gotten a number of those questions of the when, or should I. I'm going to ask John Buckingham to jump back on with us, and we're going to hit some of these questions. We got a number of questions, so I can tell you up front, we're not going to get to all of them, but you can expect some type of answer, whether it's a direct or it goes on our blog on the Prudent Speculator website. For all those that are our private wealth clients, as well as our TPS subscribers, you'll have access to that. In addition, we've had a few questions. Will this be available? Will the recording? And so, as John Buckingham mentioned earlier, we'll have compliance review it. And once they give us the go-ahead, we'll post that there on the website. And so you'll have access to be able to go back and see it, or potentially share with others in your household or your family. And so I'm going to kind of go back and forth on this. And so, John, one of the questions that we got, and I apologize, I'm looking over to be able to see the questions, was around just question relating from somebody who is a long-term believer in value and small cap, is just to address some of the underperformance that we've seen in those spaces for a while, especially more recently small caps, but just the relative struggle of value over a period of time versus growth.
Right. Well, I've got a few gray hairs and or no hair, and so we've been through periods in the past, particularly the late 90s, where value had underperformed growth for a number of years. And what we did, of course, was to stay the course, stick with what we believe in. But more importantly, it's continue to evaluate companies utilizing, fundamental financial analysis as if we own the businesses. We understand that stock prices will gyrate. Sometimes people buy the wrong stock because they hear a news story about something. We've seen that happen time and again. So just because a stock price goes up doesn't mean it's a good investment. And just because a stock price goes down doesn't mean it's a bad investment in the short run, of course. Obviously, at the end of the day, it's all about a scoreboard and a scorecard. So when I get this question, I'm always thinking about, gee, have small caps and value done poorly? No, they haven't. They've done fine. There's always greener grass. We could have invested in Bitcoin too a year ago, and we would have been a heck of a lot better off than investing in, growth stocks. So the whole point, I guess I would make, is that we think we're investing the right way. We're investing in companies that have the potential to grow their dividends, to grow their earnings over time, and we're trying to buy them at reasonable prices. And we're very patient. So, if somebody said, gee, what's going to be, one of your best stocks this year, would we have said something like Caterpillar? Well, Caterpillar's done very well. But we started taking some money off the table on Caterpillar because it's gotten to be a less undervalued name. We still like the stock, but again, just because we are playing, if you will, in the value sandbox, or for our small cap strategy that we have a managed account strategy, we're playing in that sandbox, doesn't mean that all of our companies are always going to be in the value or growth bucket. We're really trying to buy businesses, and we're trying to invest in areas of the market that have a proven history of delivering better than average return. And it's common sense. I mean, if you buy a business that's attractively priced, you're far better off than buying something that is overvalued. Yes, sometimes the richly valued names like an NVIDIA will continue to produce. But we can go back to, say, I know this is long-winded, but we can go back to the EV space. You know, everybody thought that electric vehicles were the wave of the future, and everybody was looking for the next Tesla. Well, Tesla has done fine, of course, not this year, but the field is littered with the bones of many quote unquote, you know, EV startups that didn't make it, that have gone bankrupt. And so the whole point I'm making is you want to invest in businesses that are likely to be around for the long haul and that have the wherewithal to actually produce those profits that will then allow the companies to grow dividends and reward shareholders. And I'll conclude with the point is, just because you know, a stock started off as a value stock doesn't mean it always stays that way. So if you look at the larger holdings we have, you know, Apple, you know, Meta, Alphabet, Caterpillar had been a large holding. Some of these companies don't even qualify as being in a value index anymore. Doesn't mean they're not undervalued in our mind, and that's why we're still holding them. But we don't go into arbitrary categorizations of value and growth. But we do think buying inexpensively priced stocks with dividends is going to reward investors over the long haul, as it has. And even in the last decade, we've been rewarded. Yes, there's greener grass elsewhere, but we feel we can sleep at night. And frankly, when you've accumulated wealth, most investors want to sleep at night for the majority of their portfolio.
Hey, John, real quick, a couple of follow-ups. What is the current dividend yield on the TPS portfolio?
Dividend, yeah, approximately 2.8% or so on the whole portfolio. So about twice what the S&P 500 is, a little better than what the Russell 3000 value is. And if you look at the metrics on our portfolios, the PE ratio, price to sales, price to book value, they're actually cheaper than our benchmark Russell 3000 value index. So even though we have things that, you know, Apple's and Microsoft's and those things, overall our portfolio is decidedly in the value camp. And again, happily, we've done well relative to value.
You brought up the small mid dividend strategy that we have available to our private clients. Not something that we write about in the newsletter, but just real quick, give me a couple of valuation metrics, PE, forward PE, on that portfolio if you have it in front of you. And I'm going to queue up a question for John Roessler.
Yeah, well, I don't have them in front of me exactly, but we're in the 3% range on our small mid cap value, from a dividend yield, and from a PE ratio, we're well below that of the Russell 2000 index. So we're in the 14-15 range on a forward PE basis for most of our portfolios these days. But yeah, small caps, there's been a dramatic underperformance in small caps the last, you know, several years. So I do think that's a very interesting strategy for those who can stomach the additional volatility associated with investing in smaller companies.
All right, John Roess, we're switching over to you. A couple of questions around the 4% that we talked about. And so I'm going to just kind of read them both and then allow you to combine for the answer. And so one is, when you're in your 80s, your RMD is going to demand you remove more than 4%. So any thoughts and comments on what to do with that surplus? And then the other is 4% does not consider the escalating percentage rate requirement withdrawal with RMDs that the government dictates. So like to hear about that issue. So both questions kind of on the same page, but from two different people.
Sure. So very simply, to the extent that you're not going to spend all of your RMD, you can invest that in tax efficient stock and bond portfolio. That's a good position to be in.
Awesome. John Roessler, another one for you. So if you're, and John Buckingham's going to jump in here. I know he's not going to be able to help himself. So if your portfolio is gravy, the person said it's extra, they don't need it to live on. Is it crazy to be 100% equities and thinking about maybe for heirs or for charitable things or whatever? Do you find that crazy? And maybe we'll have differing answers. I don't know. But they don't need it to live on.
I would have, it would depend on the circumstances. I would have to talk to the client, and some clients talk a good game, but when the chips are down and, stocks are down 20%, we'll see how they feel then. If it's all for heirs and the time horizon is, 30%, and I like to have something other than stocks, if for no other reason than to give you somewhere to rebalance, and buy low and sell high. It doesn't have to be a huge percentage of the allocation, but I think that's helpful and important. So I would counsel the client to maybe be at least 90-10.
Okay. Here's a question for you, John Buckingham, and I think it's one we get often, and we do write about it. But do you use the same parameters for all stocks to decide if a stock is a value stock? And I know often the historical conversations on value growth is around price to earnings and price to book and price to sales, but maybe just you don't have much time. And I know that's not an issue for you, but maybe just espouse a little bit on maybe a couple of the other metrics and other things that we take into account, and that you won't be able to hit them all because obviously sometimes, depending upon the industry, we consider some other metrics that may not be the traditional.
Yeah, well, Jason did a good job of answering the question in his question, but there is no magic formula. There's no one size fits all. We think that's antiquated. I know that price to book value traditionally has been the dividing line between value and growth. So certainly that's a metric we do look at, but depends on the industry. So as Jason said, that there are industry specific things that need to be looked at. Microsoft or software companies have never had low price to book value. So how could you ever recommend them? Well, that metric or factor isn't really germane for those companies, whereas it might be more so for an industrial or for a financial company. So we do look at a variety of metrics. We look at free cash flow yield. We look at return on equity. We look at price to sales, price to book value, PE ratio. And then we have our process, just to kind of simplify it here, is threefold. The first fold is a backward-looking valuation test, where we look at approximately 3,000 companies, score them on a variety of metrics that historically have been good indicators of future outperformance. Those that score well become eligible for further review on the qualitative side, make sure that we like the business, we think the business can grow, that it's not a dinosaur or a buggy whip maker, as I like to say. And then the final piece of the puzzle is a forward-looking valuation analysis. Is the stock actually undervalued relative to where we think it will trade over the next 3 to 5 years? And then also consider the total return potential in there, because again, dividends, as we talked about in the first part of this, are a substantial part of that equation. And Verizon is a name that we had a lot of questions about when it was in the low 30s, because it hadn't performed all that well, and but the yield was 7% or higher. And so we were getting a substantial yield in addition to what we thought was some capital appreciation potential. Happily, we've got some of that appreciation potential to go along with the yield. So there is no magic one size fits all formula, but again, generally we're on the low end of the PE spectrum, price to sales, price to book value spectrum relative to the major market averages. So we think we're fishing in the right pond, so to speak.
Awesome. Well, I want to thank both of you, Johns, for joining us today. There are a lot of unanswered questions that we haven't gotten to, so I want to thank all the participants that submitted questions. We'll either respond to you directly again, or we'll go to the blog and address some of the questions that weren't there. A number of things that we didn't get to around the importance of asset allocation and the discipline around that. And so those are important questions. If you are a current private wealth client of ours and you want to talk more about planning and the services that John Roessler helps us with our clients and our long-term relationships, just let John Buckingham or myself know. If you're not a current private client, would be interested in being one, you can reach out to me directly to hear more about that and what the requirements are and what we provide in a partnership. And how it might benefit you and your family. And then finally, as people are jumping off, you're probably going to get a pop-up, or you're going to get a pop-up with just a short survey, a couple of questions and a comment box. We want to continue to do these, provide information, thoughts, experience, and service, but we'd like your feedback to help craft how we move forward and how we make them better. So thanks again for joining us, and I hope everybody has a great day.
Thank you.
Thanks.